Get ready for more valuable financial insights from Northern California's premier retirement income planners, Dan Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
Hi, this is Dan Ahmad and Jim Files from Peak Financial Freedom Group, and you are listening right now to the Peak Financial Freedom Hour. And we'd like to welcome all of you. A lot of people have been listening to us for years, and we'd like to thank you. And hopefully we continue to give you the information, education, so you can make really good decisions when it comes to your own retirement. And anyone that has called in and we met with, hopefully you've also received some really good planning guidance. If you'd like to meet with us and you haven't done so yet, you can schedule your free consultation simply by calling pound 250 on your cell phone and saying the keyword money, or going to our website at peakfin.com and using the live chat feature, or finding our phone number to the office and giving us a call. We'll be glad to meet with you. You work directly with us. There's no obligation. There's no fee to do this, and we can find out where you're at, hopefully help you a little bit. You can listen to our podcast, and those are all our past radio broadcasts. And you can listen to those. They're on our website, or go to your favorite podcast app. We also now have these on YouTube. So our radio shows are recorded on YouTube, so you can watch as you're listening to what we're doing. And we find that ends up being really good education for people. And just don't hesitate to call with your questions, simply because we love helping people. And we love to meet with you, do whatever we can to discuss where you're at financially for successful retirement. And we build written plans. We're one of the few companies, if not the only company we know right now in the area, that's actually building written plans that include the components of making sure you have a proper budget, making sure we have an income plan projected for the next 30 years, making sure we have your taxes calculated, making sure we have legacy, making sure we have risk and fees, making sure you have everything in writing. All those things are part of the plan, because when you retire, you're not retiring out of life. We call it rewiring or relaunching your next phase of your life. So give us a call at pound 250 on your cell phone, use the keyword money, or go to our website, peakfin.com, and we can help you look at where you're at right now and hopefully push you towards the future. We're going to start this show off with the quote of the week, and then we're going to look at, if you have bonds in your portfolio, why you probably should look at the potential for some replacement alternatives. 401k mistakes you might have made or being making right now. Social Security, how do you really make the best decisions? And then what are you paying in fees? How do you find out what you're paying in fees? And then is there a way to reduce them? So Jim, why don't you start with what we call financial wisdom, or quote of the week?
This is a great quote here, and I just read it for the first time, but it really dovetails with my overall life. It says the following, and by the way, this is from Will Rogers, and Will Rogers says, a man who only learns by two things. One is reading, and the other is the association with smarter people. So I'm going to give you a quick story here about myself. I have been very lucky in my life to be associated with very, very smart people. I give them a great portion of what I've done in my life to them. As an example, when I was in my late 20s and early 30s, I formed a partnership with another very smart person. He did at Stanford. He graduated from Stanford in chemical engineering. He did his MBA at Harvard. He was the co-founder of Atari with Nolan Bushnell. He was the president of Hewlett-Packard for everything offshore. He and I had two businesses together, very successful, still one of my best friends. I then started another company with another very, very smart person. He had a PhD from Stanford. He was a brilliant person, a genius. He and I developed a company that we eventually took public, ran as a public company, and I did super well. And my third association is who I'm sitting across with right now, Dan Ahmad. Dan and I have been partners now for over 20 years. He has 160 IQ. He's smarter than both people I just mentioned. And he and I have a great, great relationship. And we provide for you an association you can make with our firm to allow you to use our knowledge, our skill set to help you plan correctly. So I love this quote, Dan, because it dovetails with my lifestyle.
No, that's great. And thank you for the compliment. I think your philosophy kind of helps all of our clients understand what we do, because I've heard you say before, you get to use our brains, you get to use our knowledge to be able to build the plan, because we force clients to participate in the entire process. We do not allow them just say, here's my data, Jim or Dan, do the plan, because that would not be their plan. It would be our plan. And that's not right. They have to participate because that's the only way they're going to understand it. And they don't think they can understand their plans. But by the time we get done, how many people actually understand their plans?
They all do. When we're done, right? But you wouldn't think you would just listening to us. You think at times they're using words that I don't understand. But when you sit down with us and you go through this planning process and we step you through it, step by step by step, you are fully involved with the planning process. You get engaged and you'll be amazed. And we often see this. One of the spouses has taken care of the money more than likely, and the other spouse may have been doing the budget, but not so involved with the investments. We actually bring both of you up to speed very quickly. And you'd be amazed at the person that you don't think in the relationship knows anything about money, how we can teach them about money and making you guys compatible to talk about money so we can put together a plan that's going to work in the future.
No, I think what you said there is key, because we find that if you have a couple, one person usually does the investments, one person does the budget, and it almost is a conflict causing relationship the way that they have divvied up the duties. Because if you're worried about the investments, you're really not worrying about the budget. If you're worrying about the budget, you're really not worrying about the investments, and they're completely different. So we have to bring everything together and make a plan. And we find almost in every case, the couple becomes a better couple simply because they're going through this process. Well, let's look at, how about this subject? And we haven't talked about it a lot, but why should people right now potentially consider replacing the bonds in their portfolio with a fixed indexed annuity, just straight up? Well, we can give you one real good reason, is that most fixed index annuities, they're invested in bonds. But instead of the client having the risk of the bonds or the bond funds going up and down in value, the insurance company, big, huge multi-billion dollar insurance company, that now has the risk of the bonds going up and down. So it takes that risk. It's risk mitigation. And if you look at what happened recently, I think 2022 with bonds, you look at how much they went down by. What did a 10-year U.S. government bond approximately go down by, which is, considered one of the safest assets you can ever put your money into?
A 10-year treasury was down 19.45% at the end of 2022, and the 30-year treasury was down 37.15%. So if you had bonds yourself, you took that risk. But let's break it down a little bit further. Let's assume you went to a big brokerage company or another financial firm. Likely they're going to put you, if you're 60 to 70 years old, in a 60-40 portfolio. You're going to have 60% equity funds and 40% bond funds. You're taking risk on both of those. What if we could show you a strategy whereby on that 40% of the bond funds, in this example, we could hand those off to the insurance carrier. They're going to be invested in bonds, but they're going to take the risk. And by doing that, they give you an opportunity to have upside in the market. So it's a really, really cool strategy that people don't understand until we whiteboard it for you. But when you actually see how you can mitigate your risk substantially just with one little movement, it's phenomenal, Dan.
When you think about it right now, the Harris poll was done about the 2023 bank failure. So it's a recent Harris poll. And they said the majority of Americans are still really concerned about bank failures. Then you look at really how safe people's monies are in banks or CDs. And this was as of 2020. It's the Board of Governors for the Federal Reserve System. And I didn't even know this. They reduced reserve requirement ratios on all net transaction accounts to 0%. Meaning they've eliminated the reserve requirements for those assets that are considered all net transactions, bank accounts, etc. So they don't even have to hold any money in reserves anymore, which does that less risky or more risky?
Significantly more risk, but explain what the insurance companies have to hold in reserves, Dan.
So when you look at an insurance company, for them to operate, play in the game, they have to have a minimum of $1 for dollar reserve. So if someone has $1 million in the bank, of that, what just has been described, nothing's in reserve. If you have $1 million in a fixed index annuity with an insurance company, they have to have $1 million in reserves, and they have to put some of their own capital into the pot as well. So they might have $1,050,000 protecting that $1 million, which is why since the 1700s, when annuities started in the United States, no one's ever lost $1 of guaranteed principal or guaranteed income from any type of annuity due to either market losses or the insurance company's failings ever. So it's not going to be sexy or exciting, but it's going to be fairly safe. You're back with Dan and Jim, the Peak Financial Freedom Hour. And right now we're talking about, should you replace some bonds or all the bonds in your portfolios right now for retirement with fixed index annuities? And we're covering the good and the bad. Well, we just discussed before this last break that banks effective 2020 for all what are called all net transaction accounts, the bank doesn't have to have anything in reserves. It's 0% reserves, meaning nothing's protecting those dollars. when you look at an insurance company that deals with fixed index annuities, they have a 100% reserve requirement. So you have $1 million you put in, they have to have $1 million on reserve to protect your money. So it's a dollar for dollar reserve, which gives you a significant advantage as far as safety of principal. And right before the last break, I talked about how annuities started in the United States in the 1700s, and no one's ever lost $1 of guaranteed principal due to any market decline or any insurance company going out of business ever because of these reserve requirements.
You know, the thing is, Dan, is that you mentioned annuities several times, and what happens, a lot of people listening here, they get the hair kind of goes up on the back of your neck, right? Because you heard the name of an annuity. There are lots of different annuities. We're talking about a very specific annuity here called a fixed indexed annuity with the option to add an income rider. And because of those types of instruments, we can do some things that you can't do with other financial instruments. So do yourself a favor, understand how this works. Don't just listen to the media and the talking heads of talking out of not understanding annuity. You should understand it. Whether you use it or not, it doesn't really matter, but you should be knowledgeable about these instruments.
Well, think about why did the advisor advise these people to put their money in bonds or bond funds? It was to protect the principal against losses and to provide a steady flow of supposed income or interest from the bonds. Well, guess what? Have they done either of those two in the last 2 or 3 years?
No.
They haven't. So the goals can't even be met by those recommendations.
Yeah.
When you look at a fixed index annuity with an income rider now, you will get the opportunity to participate in some gains when the index goes up, not all the gains, but some of them, but we don't have any of the market risk because your principal is 100% protected against all market losses. Your worst rate of return in any given year, no matter what happens, the market crashes 50%. Long bonds over a 3-year time period went down by almost 50%. Worst rate of return is 0, meaning you can never lose money because of the market, which is kind of the goal most people in retirement have for some of their money. But even more important, our principal is protected, but our income is guaranteed at a very high level, probably higher than any other level you can get on any other legal asset, and it's guaranteed for as long as you live. So if truly your principal is guaranteed against all losses and your income at a very high level is guaranteed for as long as you live, it gives people what they want, whether you call it an annuity, whether you call it a financial instrument. I always joke and I say, even if you call it a cupcake shop, if a cupcake shop would protect your assets against all stock market losses and give you income guaranteed at a very high level, would you buy it? And people would say yes. Like you said, they just don't like the term annuity. You just don't look at it as an annuity. Look at it as something that solves the problems. And then you look at the reserve requirement because they have to keep 100% of your money in reserve to protect your money. It's going to be a very, very safe type of asset. How about, Jim, why don't you go over the global financial crisis of 2008 and what happened?
Well, you know, if you had money in the market in 2008, between 2007 and 2009, the market actually dropped 57%. So if you had $1 million, you rode that down to $430,000. Now, if you're now 60, well, that was many years ago, right? And maybe you had less money then, you probably did. But now as you're getting close to retirement, imagine going through that again. Imagine going through the 2008 crisis, or imagine going through the technology bubble where the market dropped 53% over 2.5 years. If you're getting close to retirement, you have to figure out how to shuffle the deck and use different asset strategies. And what we're talking about here is just one asset strategy. We're not saying put all your money here by any means. We're saying educate yourself on this asset strategy and determine, do you want some of your money to have no stock market risk, have no bond market risk, and have income that is likely higher than you can pull off a managed portfolio that will never end? And if you say yes to just that portion of it, then get educated, Dan.
Well, think about it. When we use our 3-bucket strategy for investing and allocating clients' monies, we think it's the proper way for every retiree. And we use 3 buckets. We use a gold bucket, which is liquid money, bank money. And no matter what, you should have money in the bank. Advisors don't tell you to put money in the bank because they don't get paid to do so. But as fiduciaries, we're required to tell you what's best for you. And it's best for you to have some money in the bank. Liquid, no fees, accessible, earning decent rates of interest right now. So that's a good thing. Then the second bucket is these fixed indexed annuity buckets. And that's our green bucket. Because just like we mentioned earlier, there's no risk in it from market losses, and it gives us an extremely high level of income guaranteed for as long as you live. So in any plan, we need liquidity, and in any plan, we need safety and a high level of income. And our third bucket is our red bucket, which is our growth bucket. So as you just said, you don't want all the money sitting in a fixed index annuity. We want money in each one of these three buckets. And the third bucket is for growth. And we want to use stock market investments. There might even be bond investments in there, but instead of the bonds that lost a lot of money, which are the mid to long-term bonds in 2022, we want to use extremely short-term bonds right now that have minimal volatility, still get us a decent rate of return, but minimal volatility. But the primary asset inside that red bucket is going to be stocks and or exchange traded funds, because that's what's going to give us the chance for growth. So if we have a gold bucket that gives you liquidity and access in the bank, we have the red bucket, which will be based on mainly the stock market for growth with a little bit of risk. And then we have that green bucket that provides you 100% principal protection and gives you income guaranteed for as long as you live. That is a wonderful portfolio. And that fixed index annuity in that green bucket is a vital part of overall long-term success for most retirees.
Well, Dan, it accomplishes all the objectives almost every single retiree has when we meet with them for the first time. They say, okay, how do I protect some of my money so I have no losses? How do I make sure the income will be guaranteed for as long as I live? How do I make sure I will not run out of money? How do I make sure that I have growth in the portfolio? How do I make sure there's liquidity available so if I want to go on a vacation, I can pull money out or remodel the house? All those things that you're saying, along with what if you need long-term care costs, can be managed correctly with our three bucket strategy, Dan. You don't put all your money into one bucket, no matter how good it looks. What you do, design a strategy around what you're trying to achieve with your money so that you can have the retirement that you dreamed of, Dan. It's just simple.
Well, and that's the goal, because right now, people are told by their big 401k providers, their big banks, or their big brokerage accounts, oh, never put money in an annuity. If the client is out there, you listening right now is in retirement, getting ready to retire, and you say you want less risk and you say you want the highest income off of that, guaranteed to never run out, then the only thing you have available to do that is a fixed index annuity with an income rider. Nothing else will do those things. So we have to get over the name, and we have to get over what some people are out there saying simply because it's in their best interest to say so. Most people either deal with all stock market investments or all annuity investments. We don't. We have our three buckets. We're going to tell you to put money in the bank. We're going to tell you to put money in the stock market. We're going to tell you to put money in the annuity, which is in your best interest. When you look at liquidity, you look at growth, and you look at income on a guaranteed basis, think about it. Isn't that what we all want? The best plan now just decides how much money do you actually allocate into these three buckets, and that's what will drive your success in the future. Give us a call at pound 250 on your cell phone, say the keyword money, or go to our website, peakfin.com, and use chat. We'd love to meet with you, sit down, and educate you on these topics. You're back with Dan Ahmad and Jim Files, the Peak Financial Freedom Hour. We're talking about a lot of information that'll hopefully help you make better decisions for retirement. And right now, we're going to cover 3 mistakes that millions of people, we believe, across the United States are making with their 401ks. Actually, there's 4. In fact, let's add one, Jim, that we talk about a lot. We just didn't have it in the section. But let's talk about the first one with the 401k. And that is if you're 59 and a half or older, not realizing that those dollars inside your 401k do not have to stay in your 401k. You can now take those dollars and transfer them, roll them over income tax free into your own IRA, as long as you're 59 and a half and older, even if you're still working at your current employer. What does that do to provide flexibility for a client?
Well, all of a sudden, you're taking the right step and making sure you have a plan in place that's going to do what's in your best interest, which is to accomplish your goals in retirement. Daniel, was interesting. You talked about target date funds. There's this, matter of fact, I'll read it right off this piece of paper here. If you have a target date fund, and what that means is that you've selected a fund, it could be a 2025 fund, a 2030 fund, a 2035 fund. You might not understand what a target date means. It's a date in which you've targeted that theoretically you're going to retire. And as you get close to the retirement, these big brokerage companies or 401k companies will lessen your exposure to equities and increase your exposure to bonds. So, for example, Vanguard, a big company, right? I'm going to read just the data. Vanguard Target Retirement Fund, 2025 is a target. Over the last 5 years, it has a minus 6.1% return. The Vanguard Target 2030 Fund has a minus 2.5% rate of return over the last 5 years. And the Vanguard 2035 Fund has a minus 1.8% over the last 5 years. So if you targeted out, you're 55, you're going to retire at 65, you would have targeted that 2035 fund, you have a negative rate of return. Now, your account went up in value. Could you think you have a positive rate of return? It's because you're making your own contributions that made your value go up in your account, Dan.
Definitely. And most people that are getting close to retirement have that. Either we've seen 2020 funds that have lost more than this, 2025, 2030s, 2035s. You have to go to 2040 and above, which means you have to take a lot of risk. And that might be, 20 years after you're planning to retire, which
Yeah.
you can't be in that type of risk. So if you would have been in those shorter term ones, you would have definitely lost. And there's many reasons for that, Jim. There is lack of customization. That type of target date fund, you can't design it at all. It's already designed
Yeah.
for the masses. And it's like, this is going to work. We look at a target date fund, a 2015 or 20, it got a hammer in 2022 because it had so much in bonds and the bonds lost money and they really didn't adjust to short-term bonds. They kept the middle to long-term bonds. It got killed. Fees can be fairly high overall in that type of fund. And we have found the biggest problem is that consumers who buy target date funds think because of all the marketing materials, everything they're told, that they don't have that much risk. They have moderate to low risk in their portfolios.
And I'll give you a good example, Dan. If you take a 60-40 portfolio managed by a big company, 60% in stock funds, 40% in bond funds, if the market goes down by 53%, that's the stock market, 100% equities, right? You're going to have a 38.5% risk factor in that 60-40 portfolio.
No one believes that.
No, but that's what it is, which means if you have $1 million, the stock market drops, right? By 53, you're going to drop by about $385,000. That is not riskless. That is very risky.
How much really do clients think risks they have when they have a target date fund? I have a number in my mind. If the market drops 50%, how much do they really think? What's the range that clients have told you they think they can lose?
I'll give you two answers. Most clients will say, well, I don't think I have very much risk at all. That's one answer. The other one said, well, I might be down 5%. Maybe 10. That's what they think.
I was going to tell you exact same. Some clients think it's zero.
Yeah.
Some clients actually think they have zero, just like you said. You said that, they don't think they have much risk at all, means zero, but they think maybe 5 to 10% as a maximum risk level. And they have so much more risk associated with these things. How about then we go into the next mistake, which is not a target date fund, but it also, we need to take that into consideration that people inside their 401ks, as they get closer to retirement, not when they're young, but if they're 55, 60, 65, most people are taking so much risk, far too much risk inside their portfolios, inside their 401ks, because they don't know. They're told, hang in there, write it out, and they make their decisions on how they're going to allocate their assets because they're really not getting much help on what has performed at the highest levels for the last 12 months or last 5 years or whatever are, which ends up being the most aggressive funds. They're in them to try to get these high rates of return, not realizing that if the market crashes, like it did in 2001 and 2, or it did in 2007, 8, 9, or like it does every 5 years since 1929, they might lose 30, 40, or 50% of their assets because they're taking too much risk. And what we have to do there is we need to do a risk x-ray for you where we look at your portfolio and we'll tell you, we'll be able to put in writing how much risk you have, meaning if we go through another 08, how much risk you have. So if you need that done, which every person that's getting close to retirement, or if you've already retired and you still have a 401k or you've rolled your 401k to an IRA, we need to do a risk x-ray, a risk test for you. Simply dial pound 250 on your cell phone, say the keyword money, or go to our website, peakfin.com, go to the live chat and request an appointment, and we'll provide you a free x-ray on the risk associated with your 401k or your IRA.
Dan, I mentioned earlier, if you have a 60-40 portfolio, right, you have a risk factor of between 38 and 40%. So if the market goes down by 53, you're down by 38 to 40%. That's the facts, folks. That is it. How about if you came into our firm and we're able to show you strategies and put together a plan in place where we could take that same portfolio and lower the risk down to maybe 5%, which means rather than losing 38 to 40%, you might be down by 5%. And if you're down by 5%, we only need a 5.1% rate of return to get you back to even. So that's not as difficult. And people say, when I do that, I'm going to lose all my rate of return. No, you're not going to lose your rate of return. You're still going to get a very attractive rate of return based on history, of course. But most importantly, you've lowered your risk substantially, Dan.
One, you got to think about it. If you come in and you think you have 5 to 10% risk, we do a risk x-ray and show you in writing from a third party that you actually have 40% risk or more, which most people will. What will you do? Will you say, I'm okay, Dan and Jim, with that risk? I'm okay losing 40%? No, you'll say, fix this and fix this for me right away because I don't want 40% risk. That way you won't worry about your money as much. And as Jim's talking about long-term, it doesn't necessarily have to reduce your long-term rate of return. It simply will reduce the volatility associated with those assets inside of your portfolio. So just call us on the phone, cell phone pound 250, say the keyword money. You're back with Dan and Jim, the Peak Financial Freedom Hour, and we're going to talk about how we help you prepare for successful retirement. What are the steps we really go through? And if you want to go through these steps, just make sure, write down a note, dial pound 250 on your cell phone, say the keyword money, or go to our website, peakfin.com, log on to the live chat, and we have people there that will help set up a time for you. You can come in. We're going to give you a free financial consultation, a free second opinion about your money. There's no cost. There's no obligation. We'll never put any pressure on you. It all comes down to just getting in front of you to see if there's things we can do to help. And if there are, we will. If there's not, we'll tell you the truth and we'll part ways as friends. But just make sure to give us a call. Don't procrastinate, and we'll be glad to help you. And if you look at what we really do, we first, Jim, sit down with people and we find out what they want their vision for retirement to be. And a lot of times they don't know because they think what they're supposed to answer when we ask them, what do they want retirement to be? They say, I want my assets to grow. That's how they'll answer. That's what they think retirement's about. Yep. But we have to come up with, what do they want their money to do for them? How do they want their money to enhance their lifestyles? How do they want their money to enhance the lifestyles of their loved ones, their kids and grandkids, or maybe their favorite charities, their school, their church, etc.? So that's the first main thing, is figuring out what their drive is, what we want the money to do. Then the second most important fact is going to be, how much money do they need to spend each month, or how much money do they need for retirement? And that comes down to doing a budget. And it's not a tight budget, but it's a really good, strong, loose budget that says, if I have this enough money coming in for each category on a monthly basis, I will have a great retirement. And we take that number and let's say it's $9,000. We don't want to just create a plan that gives them $9,000. We want to create a plan that will give them $12,000 a month, because now they have $3,000 more to spend. And if we can do just those first two steps, we can help them realize their vision, help them now create a budget that we know will make them feel comfortable. If we can generate that in a higher level, what does that do to then people's psyche? What does that do to their emotions when it looks at planning?
Well, those are the first two critical elements that everybody has concerned about. How do I have enough income in retirement to maintain my budget, period, right? And just having a bunch of investments and thinking you can take off 3% or 4% in income doesn't solve that problem. Because again, going back to 2022, if you had a 60-40 portfolio, that portfolio was down about 22% by year end. So if you were taking off just 3 or 4% because you thought that could be work just fine and dandy, well, that year you didn't work fine and dandy, right? It caused you a lot of stress, or it would have caused you a lot of stress in retirement. So making sure we identify what your budget is and how do we get you enough after-tax income to maintain your budget. And ideally, what we'd like to do, let's say that budget's $9,000 and you have, let's say, $3,500 of Social Security income coming in. That's guaranteed income. What if you had another pension or rental real estate was another $2,500? That's income's going to come in, but you're short $3,000. Wouldn't it be nice to now figure out how to solve that problem by getting more guaranteed income, so that your $9,000 or even more than $9,000 was going to be guaranteed from different sources? Wouldn't that make the client feel comfortable?
Well, it's been proven that it does, because University of Chicago has done multiple studies over the last couple decades on what has been the best decisions retirees have made to decrease their stress levels at retirement. And that is creating as much dependable, guaranteed lifetime income as possible. Social Security, pensions, and annuity income are the three sources that allow you to now get income guaranteed for as long as you live. And the more of that type of income you have, do you really think you'll be less stressed the more of that income you have, or you'll be less stressed and more happy? And it comes across in all these studies that you'll be less stressed, you'll be happier, you'll be healthier, and you'll live longer. And that's the kind of advice we're going to give you, is to make decisions that will give you a lot less worry at retirement and allow you to live the life that you want. And we're going to then put together, the next steps of your plan would be, we're going to put together an income plan that'll show every year where each source of income is going to come from. So let's say you have Social Security, your spouse has Social Security. There's two sources. Let's say one or both of you have pensions. Those will be other sources. You have rental income. Then we're going to look at, can we develop some additional dependable guaranteed lifetime income using a fixed index annuity with an income rider that'll guarantee for as long as you both live, the income will not end. And right now, for example, if you're 60 and you're a couple and we defer it for 5 years, you can get a 10% payout of whatever we put into those accounts. That's awesome. Then we're going to do a tax analysis. We're going to tell you how much money can potentially be left to the beneficiaries. We're going to do a fee analysis, a risk analysis. All these are just part of a standard plan we can set up for you. And if we do this, it's virtually guaranteed you will worry less about your money, Jim.
Well, again, as a fiduciary, Dan, I don't think you can call yourself a fiduciary unless you're doing all of these things.
Across the board, I think ultimately that the plan for a client is to make sure that every decision that's being recommended you undertake is in your best interest. And the only way you can do that is if you get every recommendation in writing. So right now, when you think about your current situation, an advisor, have they put everything in writing? Have they put the amount of risk you're taking in writing, meaning how much you could lose? And I'll bet they haven't. Have they put your total fees in writing? I'll bet you they haven't. Have they put your total income plan or the taxes you're going to pay or how much you can leave to your beneficiaries in writing? I'll bet they haven't. And have they written everything out and signed it as your fiduciary? And I'll bet they haven't. Well, guess what? That's exactly what we do. Jim and I do that for every single client that goes through the process because we know it's the only thing. That entire process is the only thing that's going to allow them to feel comfortable throughout retirement. So if you'd like this kind of consultation, this kind of plan, dial pound 250 on your cell phone, say the keyword money, or go to our website, peakfin.com, and use our live chat feature.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.